Okay, a little oil and gas. Yeah, this is Oil and Gas Lending 101. I'll start with this slide. Basically gives you the life cycle of a typical, what we call upstream exploration and production company. It's very capital intensive, and on the front end, they're acquiring leasehold, which has no associated cash flow, so that requires family capital, private equity, business angels. I've seen situations in the last few years where $200–300 million has been spent with private equity money just to acquire leasehold in order to do future development. And in some of those cases, as I mentioned earlier, the natural gas distribution system in the United States is a fairly mature business, but as it relates to Marcellus and Pennsylvania in particular, a lot of this acreage was acquired with no infrastructure. So that $200–300 million that was spent all of a sudden got caught up in the downward price cycle with natural gas going from $4.55 per thousand cubic feet down below $2 per MCF as we refer to it. So at that level, it's not viable to both drill the well and build out the infrastructure to produce the gas, particularly when the gas price was a result of an excess supply. But in a normal cycle, we generally, as a commercial bank, we generally get involved about midway through the takeoff phase. The venture capital phase is where there is we're always lending into cash flow. People ask us, 75% of our credit underwriting is centered around cash flows and future cash flows. The other 25% can be this development cycle as the company continues to spend capital. I've seen a lot of situations, if you go back more than 2 years ago, a lot of these companies that were private equity funded with some commercial bank debt, a lot of them sold out. A lot of them did their exit, their asset sale before they even got to the development phase. With the shale revolution and the appetite for bigger and bigger companies, particularly public companies, in order to feed the street, as we call it, tell the investor public that, hey, we're building, we're growing. A lot of these companies actually got sold out way before the development phase. That's different from 20 years ago when this business was a buy and hold business, particularly with the families and the private sector and even the public companies. If you go back 20 years, it was a buy and hold strategy. They would develop the asset and actually just maintain the production for a long period of time. That all changed about 6 years ago into a buy and flip strategy. So again, a little reserve-based lending 101. What East West does and what most commercial banks do is we lend to E&P, or exploration and production companies, what we refer to as the upstream part of the business, and midstream companies, which is the infrastructure to move natural gas and crude oil from where it's produced to where it's consumed. The midstream segment of the business is also heavily related to the reserves in the ground. We have to evaluate, okay, are there enough reserves in the ground that are going to be produced by the upstream businesses to feed the system and make it an economic project for the midstream segment of the business. The one that's not mentioned here is what we call downstream, which is the refining and processing segment of the business, which is historically been a very risky endeavor for commercial banks. So we're not going to be lending to many refineries. So the next thing we look at is the management quality, what their track record is. Private equity firms do a lot of vetting for their management teams. We don't rely on them completely, but they do their homework in terms of sizing up management and staking them with hundreds of millions of dollars typically. And then on the technical team is both geological, understanding the areas that these companies are investing in, the geology and the engineering, and then the operational, the actual execution of drilling the wells and getting the resource to be produced. Again, I didn't mention earlier, before the talk, I was talking about capital sponsorship. What has changed in our business is upstream companies and midstream companies had a tendency, when money was available from commercial banks and from other mezzanine type lenders, anytime you have a price shock, as we've seen, they become over levered relative to how much debt burden they have, relative to how much cash flow they can produce. So to correct that, both for existing situations and for go forward situations, the capital sponsorship, the private equity component is going to become increasingly, or has become increasingly more important to our business of lending from a commercial bank's perspective. And then the quality of the properties is always important. We look at assets in terms of both the cost of producing the properties and also the concentration of the production, because we don't want to be too heavily concentrated in a few number of wells or a single lease, because there are some operational concerns, mechanical concerns. We've seen wells that have stopped producing because the wellbore has collapsed, or if you're too heavily dependent on one well or one lease, and the geologists and the reserve engineers are wrong that there aren't that many molecules in the ground that are going to be produced, and you have to revise that estimate downward, it becomes a real problem when you're doing your valuations and doing your estimation of what future cash flows are going to look like.
So you don't depend on Netherlands Sewell reserve report. You pinpoint a specific field or a specific well and said, I don't agree with the engineers.
Well, we start with the Netherlands Sewell report. Netherlands Sewell is a well-known international third-party engineering firm, and they do excellent work. And you also have Ryder Scott and Cawley Gillespie. So you have some nameplate companies that are third-party reserve engineers that we rely on heavily. Right. We employ our own reserve engineers. We have 2 on our staff that their job is to go through the third-party reserve report. There's general consensus between our technical staff and the technical staff that's either hired by or contracted by our clients. It's just, there are so many variables.
It's not a slam dunk.
It's not. There's a lot of art as well as science to determining. I mean, they look down the wellbore and they say, okay, we're going to produce 10 BCF of gas, billion cubic feet. Right. And that could be wrong plus or minus 30%. And so if we're wrong by 30%, then our valuations, as we look at our loans every 6 months, we do an asset review every 6 months, and we do exactly that. We reevaluate what reserves are going to be produced. We have to say, okay, at what price are they going to be, or what cost are they going to be produced at? What price are they going to sell the commodity for? And we come up with a cash flow analysis that goes out 20 or more years. And then we talked about the reserve report. We have to determine, as I said, we have to determine what price this commodity is going to be sold for 5 years from now. Well, the way East West Bank does it is we look at the financial markets as being the most transparent and the most collective conscious of everybody who's interested in the crude oil or natural gas as a commodity. We look at the price strip, the NYMEX price strip. And we look out 4 or 5 years and we say, okay, this is what the consensus is of the market of what this commodity value is going to be. And as a lender, we have to be more conservative than that. We're not trying to predict what prices are going to be. We just have to pick a price that is safe enough for us to lend money. And that number today is 85% of the forward market is what we are going to use for lending purposes. So we apply that to the reserves we think are going to be produced, at what cost they're going to be produced, and we come up with a discounted cash flow analysis. Now, there are different types of reserves. We're cash flow lenders, so PDP is proved, developed, producing. That's what's producing today. That's our 75% of our reliance is going to be on PDP. PDNP is proved, developed, non-producing. Science tells us the reserves are there. They're going to be produced at some point in the future with a little capital investment. They can be produced in the future and will generate a cash flow as a result. PUDs are proved undeveloped reserves. That's a well that hasn't been drilled yet, but you have a well next to it. And so you can correlate, the geologists and the engineers can correlate that this proved undeveloped well is going to produce, after you drill the well and make the capital investment, it's going to produce at a rate, at a price. The advance rate, as I said, we use a discounted cash flow analysis approach. We use a PV9, 9% discount. The advance rate is typically about 60 to 65% of what the present value, net present value is today at 9%. We look at the reserves twice a year. We adjust for reserve estimates. We adjust for cost trends. We adjust for price. And then we do it all over again. We do our discounted cash flow analysis again. We apply our advance rates. We make sure that the future cash flows will amortize the debt in an orderly fashion. And so it's not a jump ball, but every 6 months we're resetting what amount the borrower can advance under a revolving based loan. And then hedging, financial covenants. Didn't mean to skip over that. That's very important because in March of this year, the Office of the Comptroller of the Currency kind of changed our world, and the Fed and the FDIC followed suit. The biggest change was they determined that all debt is created equal. We used to play in an arena where we were the senior secured lender. We had payment preference, both in cash flow and liquidation. We almost always got paid. And so if we had second lien debt or mezzanine debt or unsecured bonds behind us, we were more or less interested that our customer was able to service the interest and keep current and not default on those obligations. But in terms of impacting our ability to be paid first, we gave it the position we thought it was in was secondary. Well, now the government has come in and said all debt's created equal, which means when you're testing leverage, when you're testing total funded debt against last quarter's EBITDA, last quarter's cash flow, all of a sudden leverage profiles jumped, sometimes from 3 times to 6 times. Our comfort in terms of covenants as a senior lender, we like to see leverage maintained, and the government agrees, at 3.5 times or less. You see a lot of existing situations that are over 4 times levered. My business is all new business, new management teams, new opportunities, because a lot of existing companies they're kind of stuck where they're at because their leverage profile is 4 and 5 times. And if I were to refinance it, the government would say, well, you just booked a substandard loan, and my management in Pasadena wouldn't be very happy with that. So, on the price side, we're very bullish on hedging. Many companies went into 2016 unhedged because they were unhappy with the forward price. Well, many of them would be more than happy to have $65 or $70 crude oil prices today had they hedged back in late 2014 or early 2015. So we're really big on hedging 2 years out and kind of making it a rolling program, which every fiscal quarter. Minimum 50%, maximum 75 to 80%. We feel like hedging over 85% is kind of getting into a speculative range because of the variability of future production. Right. We've seen some situations where they were hedged at 80, 90%, then you had your reserve revisions, and all of a sudden they're 110% hedged, which is okay in an upwardly moving price market, but not so much.
You don't look at 2Ps and 3Ps at all? We
don't look at 2P or 3P. What Max is referring to is what became prevalent with these shale plays in particular was probable and possible reserves. What I talked about under the reserve categories under risking, those are all developed. Geologists, engineers, third parties, banks all agreed that the reserves were there in certain quantities and can be commercially produced at today's price. Probables and possibles are reserves that are extensions of fields where there is no existing production, there's no control, as we call it, there's no closeology, you don't have a well across the fence line that you can correlate to drilling a well in this location. So you have, and many times we've been asked, do we give value for acreage that has 2P, 3P, which is probable and possible reserves, and the answer is no. Wall Street may like it, but the commercial banks don't. So again, I touched on it. We have 2 reservoir engineers on our staff. What they do, they have the capacity, the capability of producing an engineering study from the ground up. That's not their function in our world. Their function is a review function, looking at the third-party reserve reports that our clients present to us. Mortgages, all of our lending is secured. We like to take at least 90% of the value of the oil and gas properties under mortgage. Sometimes that last 10% you get into diminishing returns. It's just you get into the smaller values, and the cost is just not practical to go for that last 10%. Collateral meets loan requirements. We have guidelines around concentration of value, as I touched on. We can't lend on one well. We like to have an oil-gas mix. A lot of companies are weighted almost 90% one direction or the other, but it's always best to have a balance in your reserve mix. The third-party reserve report, and then many of our companies are startups. They're funded by private equity, so there's not a lot of historical financial data, but they're usually buying the asset from somebody who has operated the property for a period of time. So we can look at the historical production. The decline curves are what the engineers say the future production is going to look like, and then the lease operating statements are what is the cost associated with this activity. And that's important because that's where, as a lender, we can make our biggest error is not getting the expenses right, because that can really impact your cash flows and your discounted cash flow analysis. And back on that, again, in the news this week, the earthquake in Pawnee, Oklahoma, that the USGS and other experts are blaming on saltwater disposal. This was an unusual situation in that the article I've read said that the earthquake originated epicenter was only about 3,000 to 4,000 feet deep. Now, most earthquakes happen much deeper than that. So that does correlate where saltwater disposal operations are occurring at that depth. So it's curious, I'm not a geologist, but it's curious that they had such a shallow earthquake, and so immediately the state of Oklahoma, the regulatory bodies, they shut in 37 saltwater disposal wells. The problem with that is, as it speaks to cost, on the lease operating statement, it costs 25 cents a barrel to dispose of salt water in a saltwater disposal well. It costs about $1.75 or $2 a barrel to truck it. So if your option to dispose of it in a historical fashion at 25 cents a barrel, if all of a sudden your cost is now $1.75, it significantly changes the net profit of the project and the resulting discounted cash flow. So we're paying particular attention to that. But in Oklahoma, with oil and gas operations, you'd produce, absent hydraulic fracturing, there is a lot of water produced along with the crude oil. In many cases, the water production exceeds the barrels. You have more barrels of water production than you actually have barrels of crude oil. So it's a real it's a real costly situation if you're no longer able to inject that in the ground and have to truck it to some other site. Where are oil prices going? You have people on all sides. Again, my personal opinion is we're kind of range bound between 40 and 50 for 6 months to a year. It ought to break out above 50. Again, we're achieving balance in the market, but it's going to take a little more duration, a little more working off that to get above $50 a barrel, probably to this $60. You know, I'm more in line with the chairman of Anadarko than I am with the $10 barrel. I mean, I've seen $10 barrels in my career twice. I don't really want to see it again. And Harold Hamm is always pretty optimistic on crude oil. He has to be.
Yeah.
Here's if you want to go look for some of the information we've discussed today. The EIA and the rig count, the Baker Hughes, the Wall Street Journal always has good articles on energy. And then the Bankruptcy Monitor by Haynes & Boone.